Clay Smolinski from Platinum Asset Management. Clay, thanks for joining us.
You're more than welcome.
We're just about to surge into 2018, and hasn't this year gone quickly? Fantastic year for Platinum Asset Management as well. You guys are back in town. So what's big on the agenda in terms of investor opportunity for 2018?
Certainly. So there's a few. So first of all, look, we've got 30% of our portfolio invested in China. We think there's still massive opportunities for investors, and these are long-term opportunities. We can see a lot of growth out of this market for many years to come. But drilling into that opportunity set, really over the last few years, we've had a lot of money invested in Chinese consumer companies. So companies really benefiting from the growth in the Chinese consumer, whether that be some of the white spirits makers or the Chinese internet advertising companies. Those businesses have done very well.
Tencent, for example, has risen 100% in the last 12 months or something like that.
Absolutely. Yeah. So those businesses are now starting to become appreciated in the stories by the wider market. And we've actually started to move the portfolio in China to some of the more, probably more cyclical names, but really invested in some of the more kind of more heavier industries. And I'll give an example of what we think one of the best examples is. Everyone knows that China has an environmental and pollution problem, and this has become a real key issue both for the community and the state. You go to China, you feel it in the air and in your lungs. So there's huge opportunity to spend around cleaning up that situation. Wastewater, waste incineration. The government's forcing a lot of traditional coal burning industries to move to natural gas. And we have several investments along this theme. So we own companies like ENN and China Resources Gas, which basically build out the gas transportation pipelines. Yeah. And if we're going to be burning a lot more natural gas, we're going to need a lot more transportation facilities and pipe to be laid. And we own companies like China Everbright and Beijing Enterprises Holdings. So these are not household names, but what do they do? They're big in wastewater and sewage, and also waste incineration. So look, China has been going to a lot of these heavy industries and saying, look, you need to start meeting wastewater and sewage regulations, and we're starting to see a lot of this capital really ramp up as these companies move to comply. So we have a group of utilities who are generally trading on anywhere between 8 to 12 times earnings. Most of their businesses are growing, which is a low starting point, especially when you compare it to US utilities or European utilities that trade on more like 20 times earnings. These businesses on average are growing at 10 to 20% per annum. Wow. So we think that's a very interesting combination. So that's China. We've got roughly...
You've backed oil really well. We cut a video 18 months ago, and I think your words at the time were in 18 months' time, oil will be at 70. We're almost there. It was up today, day of shooting, so I know you guys are still keen on energy.
Yes. So it's nice that case has started to play out now. We've got roughly 11 to 12% of the portfolio in direct energy exposure. Energy exposure meaning? Oil, either oil producers themselves, natural gas producers that have their sale price linked to oil, or oil services companies that are essentially putting in the capex to produce more oil in the future. Look, the industry's been through a 3-year recession. We're now seeing from the data side, oil markets have balanced. We're now starting, we watch inventories. Inventories are the best, the purest indicator of demand versus supply, and inventories are falling, which is simply just telling you we're now consuming more oil than we're producing it. And the oil price is reacting as you would expect. We've now moved up to $65 range. So we own direct exposure, so we own Impex in Japan, which has recently completed the enormous Ichthys project off our Northwest Shelf. And we own companies like FTI Technip in the US, which is one of the major suppliers to offshore deep water, essentially oil and gas equipment, very high technology industry. These companies, so we take Impex, we think at a $65 oil price, it's trading on roughly 7 times earnings. and FTI, even on today's depressed level of activity, is trading on circa 12 times, and those earnings can rise quite considerably should spending come back, and we feel that spending needs to come back. There's time for oil to have another cycle, so we think that's quite prospective.
So China on the long game, and you've been playing that for a while. Long on energy at the moment.
Yes.
Anything on the short side that tickles your fancy at the moment?
So we've put on a number of shorts, particularly in the consumer packaged goods sector. So these are classic names like a Kellogg's in the US. And why is this interesting? So you look at many of these companies in this field and they haven't grown their earnings or even their sales for the last 15 years. These are mature industries that serve Western markets that are not growing. But in spite of that pretty boring performance, the market chose to re-rate these businesses to often 20 times or higher. Why? We've just gone through a period where the market loves safety. It was safe. It gave me a 3 to 4% dividend yield. Great, I'll have that. But beneath that, there's a lot of changes underfoot. The first change that they've been battling now for a couple of years is there's been just a change in consumer preferences. Low sugar, low carbohydrate. People want to move to healthier eating. You go and look at the nutritional information on the back of a Kellogg's cereal box. It's high sugar, high carbohydrate. These are not health food. So what you've actually been seeing is consumption of their underlying goods are falling between 4 and 6% per annum on a volume basis. Now, they've been trying to defend against that by price, but they've also been trying to defend against that by cutting out a lot of costs. So whilst volume has been falling, so have costs, and they've been able to keep their earnings essentially flat. But they've now gotten to a point where the costs have been cut, and there's no more to do. The second large problem that they also faced is, at the margin, our grocery shopping is starting to move online. Certainly outside of fresh, we are buying non-perishables online in the US with the likes of Amazon, and we think that will only continue. And what we've seen with the shift to online on Amazon, as a Kellogg, in years past, your moat was you could demand shelf space at Coles. You had the shelf space, and we buy robotically what's in front of us. In the online world, the shelf space is infinite. Suddenly we've seen a number of these smaller brands developing healthier, more niche products suddenly pop up as the number one ranked option on Amazon, getting great reviews, and they're taking market share. And the interesting factor is that we see is we look at the market share of a lot of these consumer goods companies in the bricks and mortar store, you look at the top three, and then you look at the market share of the online sales, and the top three are totally different, and two of the names are companies you've never heard before. So it's a really large change, and we just think, you've got challenges to the business, you have a very, very rich valuation, and that generally puts, that's a decent recipe for making money on the short side.
So we like China and energy on the long side, cautious on, it's the Amazon effect is presenting some opportunities to short. So looks all set for an interesting 2018. Thanks for your time, Clay.
You're welcome.